going to be a little bit quieter after 2 really busy weeks. But there should still be lots of information for investors to consider, both from a top-down and a bottom-up perspective. On the macroeconomic front, the week's key feature is likely to be the release of the latest German factory orders data on Tuesday the 6th of August. Now, some of you might not be so bothered, but Germany is the globe's 4th biggest economy and it is an export powerhouse. So, if all is well in the world, then these figures should show it. Equally, if anything's wrong, that might show up too. And the bad news is that the German factory order numbers in 2019 have been very weak indeed, as we can see here. The May index reading of 100.2 was the lowest since autumn 2016, and it represented the 10th straight year-on-year drop in order intake. The actual rate of decline was 8.7%. Now, the history books show that that's the sort of drops that we get in or going into recessions. Whether this is the impact of global trade tensions or something deeper than that remains to be seen, but this dataset may explain why the European Central Bank is now taking somewhat of a dovish line on interest rates. Back home, we don't quite have the deluge of results that we've had in the past fortnight, but we should still get plenty of informative updates from large and mid-cap names alike. Companies which may be worthy of note, either in their own right or because of the read-through they provide on the UK or global economy, include Aerospace and Defence Expert Senior on Monday the 5th of August, Intercontinental Hotels, Rolls-Royce and another aerospace specialist Meggitt on the 6th. It's a big day for insurers on the 7th, with Legal & General and Phoenix Sector report, alongside asset management giant Standard Life Aberdeen and engineer Spirax-Sarco. On the 8th, we have another insurer, Aviva, as well as Coca-Cola Hellenic Bottling Company, and also FTSE 250 real estate investment trust Derwent London. Finally, on Friday the 9th, to finish, we have advertising giant WPP, bookmaker William Hill, and Hikma Pharmaceutical. They're all due to update their shareholders then. But for me, the stock most likely to cause a big fuss in the week ahead is megabank HSBC. It's due to release its first half results on Monday, the 5th of August. As we can see here, the shares haven't done that much over the past year, falling by around 10%. Over the same period, the FTSE 100 is very slightly down in capital terms. Now, HSBC's first quarters back in April actually weren't bad at all, but the company's got 4 strategic issues to address, and they could all go a long way to shaping both short and long-term financial and share price performance. First, although HSBC positions itself as a global bank, Hong Kong generates nearly half of group profits, which is interesting right now given the current political unrest there. Second, the US operations are subscale and frankly need a bit of a reboot. Third, profit margins in the UK are pretty modest and the mortgage market remains extremely competitive. And fourth and finally, the investment bank, rather like its equivalent at Barclays, continues to soak up a lot of regulatory capital, but without necessarily generating the returns to justify that particular investment. To see how these issues are playing out, analysts will be looking at 2 main figures, pre-tax profit and the dividend, when they look at the first half figures, but they'll then dive behind those numbers to look at 3 more trends to assess quality as well as quantity. Now, in terms of the headline pre-tax profit number, HSBC's first quarter result, as I said, was pretty good, with revenues up 5% and adjusted pre-tax income growing 10% to $6.4 billion. On a stated basis in the first half of last year, HSBC made $10.7 billion, so that's your benchmark. On an underlying before bad stuff basis, it actually made $12.1 billion a year ago. In the second quarter last year, it made 6. But as we can see, the figure is quite a volatile one. Now, in terms of the dividend, HSBC paid 3 quarterly dividends of 10 US cents a share, and then a final fourth quarter one of 21 cents last year to make 51 cents a share in total. That's around the 40 pence mark at current exchange rates. Now, analysts expect the same for this year, so look for a 10-cent second quarter dividend. If there's no change this year, that'll be the 5th year in a row without dividend growth. Still enough to imply a dividend yield of around 7.7%, but earnings cover isn't great, and investors need to do their research to make sure they think this payment is safe if they are looking to watch HSBC as a potential income pick. So those numbers will provide quantity, 3 more will define quality, and here again the devil will lie in the detail. First, analysts will look to the level of restructuring costs, loan impairments and litigation and conduct costs. Since 2013, that lot has cost HSBC nearly £28 billion, more than a third of its total pre-tax profit and 2/3 of dividend payments over the same period. This trio cost HSBC £1.6 billion in the first half of last year, and with a deadline for payment protection insurance in the UK coming up, it'll be interesting to see if we get any increase. Second, watch the net interest margin. This measures how profitable HSBC's loan book is, as it borrows money in the short term or attracts deposits at one interest rate and then loans the cash out at hopefully a higher interest rate over the long term. The problem now that we've got, as central banks look to cut headline rates, is that the yield curve is flattening and the gap between short and long-term rates is narrowing. That in turn squeezes the bank's net interest margin and hurts profits. And as we can see here, HSBC is starting to feel that squeeze. Its net interest margin in Q1 was 1.59%. Finally, watch the cost to income ratio. HSBC has gradually chiseled this down and it stood at 60.5% in the fourth quarter of 2018. Cost control will help the bank make the most of any revenue increase or limit the damage from any decrease. Thank you for watching, and I look forward to seeing you next time.